Welcome back to Investing Talk Podcast.
Today we're looking at Yueda Digital Holding. The company we'll refer to simply as the stock symbol. The big question is it a good time to buy now?
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there is a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. This company, Yueda Digital Holding, it's gone through a really major transformation recently.
Right, they changed their name. It used to be AirNet Technology.
Exactly. That was back in September 2025. They rebranded to Yueda Digital Holding, and it signals this really aggressive move into Web3 and the whole digital economy space.
Okay, so more than just a name change. What's the strategy?
The core strategy now is basically crypto accumulation. They've set up a formal treasury framework. Think Bitcoin, Ether. That's the focus, alongside, general investments in Web3 infrastructure.
They really want to be seen as a crypto holder then.
Pretty much. And they backed it up almost immediately. There was this huge headline piece. They announced receiving a massive amount of Solana tokens.
Oh, yeah, I saw that. It was something like, what, 750,000 tokens?
749,965, yeah. Came from warrant exercises settled onto their balance sheet early September.
And here's where it gets really interesting, right? Because based on pricing around mid-October, that one asset, just the Solana, was worth roughly $149.2 million.
It's a staggering number, especially compared to the previous operational size. It completely dwarfs it.
Definitely gives the bulls something strong to argue about. Immediate asset backing.
And it seems like it got some market validation, too. After this pivot, they managed to close a $28 million registered direct offering, an RDO, in October.
Okay, tell me about that RDO, because the numbers looked a bit strange there.
Yeah, what's really interesting is the pricing. The offering price was nearly 3 times the company's market cap at that time.
Wow, so someone was willing to pay a huge premium over the public price.
It suggests some institutional or, sophisticated investors really believed in the new direction, the crypto treasury potential. They paid up for it.
And wasn't there also some chatter, maybe more speculative, about the CEO putting his own money in?
Yeah, we saw that in some forums. The story goes he invested about $1 million personally when the market cap was tiny, like only $2 million.
That kind of thing definitely fuels momentum, even if it's not, fully confirmed everywhere. Sends a strong signal.
But this brings us straight to that tension, that puzzle you mentioned earlier. If they have, let's say, $149 million in Solana, plus $28 million in fresh cash, seemingly backed by keen investors, why is the stock trading so low?
Exactly. That's the million-dollar question, or maybe the $149 million question here. Why is the market seemingly ignoring these assets and pricing it like it's, about to go bust?
Because, frankly, the underlying business before the pivot was in shambles. You have to look at the financials they were running from. It was severe distress.
Okay, how severe are we talking?
We're talking catastrophic. Revenue from their old business, the legacy operations, it collapsed by nearly 60% year over year in 2024.
60%? Wow.
Yeah. Their entire annual revenue fell to just $343,000.
$343,000 for the whole year.
The whole year. I mean, think about it. That's less than what some individual executives make at other companies.
Okay, so they were really running on fumes, basically.
Absolutely. And the losses were piling up fast. Their trailing 12-month net loss hit a massive negative $35.54 million, just burning cash at an alarming rate for their size.
So the market's pricing that history, that operational risk, not the shiny new crypto assets.
It seems that way. And that leads us to the technical picture, the stock price itself, which is just shocking.
Yeah, it was trading around, 5.5 cents? 0.056 cents as of early November.
Right. And that's down over 98% in just 1 month.
Right.
98%. The 52-week high was $6.69.
That's not a correction. That's an implosion.
It's an implosion. And it's likely driven by that historical distress and by the execution of that $28 million capital raise.
Ah, the dilution effect.
Exactly. Heavy shareholder dilution. They've got something like 184.25 million shares outstanding now.
Okay, maybe quickly explain dilution for anyone listening. Why is it so painful?
Sure. So imagine the company is a pie, right?
Yeah.
Before the raise, maybe you own, say, 10% of that pie. To get that $28 million, they had to issue tons of new shares, effectively making the pie much bigger but cutting way more slices.
So your original 10% slice suddenly becomes a much smaller percentage of the total pie.
Precisely. Even though the company has more cash, your ownership stake shrinks, and that often pushes the share price down. It hurts existing shareholders.
And the way the price is bouncing around, the volatility suggests this isn't driven by fundamentals anymore, is it?
No way. The average weekly price movement is a staggering 45.4%.
45% a week.
Yeah. That's not stable long-term investors. That's the fingerprint of highly speculative trading, maybe algorithms, short-term players. It's incredibly risky territory for a typical retail investor.
And that super low price point, the 5 cents, that creates another ticking clock, doesn't it? The delisting risk.
Absolutely. It's a huge risk. Being a penny stock at 0.0566 puts them in serious danger of getting picked off the Nasdaq queue.
They need to meet that minimum bid price, usually $1, right?
If they stay below that for too long, Nasdaq, you can delist them. And if that happens, liquidity just evaporates. Your shares become incredibly difficult, maybe impossible to sell at any reasonable price.
So, okay, we have this huge pile of Solana. We have $28 million in cash, but we also have this history of failure and this delisting threat. It feels like the key is transparency.
That's exactly it. The biggest red flag right now is the lack of clarity on that $28 million. They've said the general goal is accumulating Bitcoin and Ether, sure, but what specifically is the plan?
Yeah, is it paying off old debts? Is it building actual Web3 tech? Is it just buying more crypto and hoping the price goes up? We don't know.
And without that detailed disclosure on how they'll deploy that RDO money, the risk just stays incredibly high. Investors need to see a concrete plan.
And where there's no clarity, speculation fills the void, right? We're seeing all sorts of rumors.
Oh yeah, talk of potential big partnerships, maybe acquiring some smaller crypto companies, even using some cash for a share buyback to fight that dilution.
But it's all just talk, though. None of that is confirmed in the sources we looked at.
Not confirmed at all. Right now, the only definite upcoming event is their earnings release, scheduled for November 17th, 2025.
What are people expecting from that? Any chance of a positive surprise?
Well, given the history, analysts aren't really expecting good news on the operational side. The focus will absolutely be on the balance sheet confirming those assets, and crucially, any commentary from management about the Treasury plan and how they'll use that capital.
Okay. Now, something else I've seen popping up a lot online, people comparing this stock to that other ticker, YAI, touting it as the next YAI.
Yes, and we really need to highlight that comparison, but as a major warning sign.
A warning. Why? People seem excited by it, thinking low price, big potential.
Because the source material explicitly points out that the stock associated with that YYAI ticker was, well, a cautionary tale. It involved massive dilution, followed by a really painful reverse split that basically cooked investors, as the saying goes, left them holding worthless bags.
Okay, can you unpack that? A reverse split after heavy dilution. Why is that so bad for investors, especially retail?
So reverse split is when a company reduces its number of shares to artificially boost the price per share. Say they turn every 100 shares you own into just one share.
The goal being to get back over that $1 minimum for Nasdaq, right?
Usually, yes. But if the company still has those fundamental problems like huge losses, no real revenue, massive potential for more dilution, the reverse split doesn't actually fix anything. It just consolidates the shares.
And the price often just crashes again afterward?
Very often. The underlying issues pull it back down. It can feel like a desperate move, often happening right before total failure, and it tends to wipe out the small investors who bought in, hoping for a cheap recovery.
Wow. Okay, that puts the current 0.056 BARTs into a much more sobering light. You're not necessarily buying a bargain basement deal.
You're buying the extreme risk of that exact scenario playing out. You're essentially betting that this time the pivot will be executed perfectly, that this management team can navigate the incredibly complex crypto space compliance, volatility, regulation, which is totally different from their old business.
Right. So let's bring it all together for a final assessment. We've got the big crypto asset pile, the fresh cash versus the terrible financials, the dilution, the delisting threat. What's the bottom line for someone thinking about buying this stock now?
Look, the consensus from the sources we reviewed is crystal clear. This is a highly, highly speculative, distressed situation. Based purely on the fundamentals, near zero revenue, those huge losses, it gets maybe a 1 or 2 out of 10 rating.
So not really an investment in the traditional sense.
Not at all. It's a pure risk bet, a gamble on survival and a complete turnaround. Any money put in here carries an extremely high risk of total loss. You have to be prepared for that possibility.
You're betting that they can successfully deploy that new capital into the crypto treasury, turn things around operationally, and do it transparently.
Exactly. The assets, the Solana, they seem real. The pivot story is compelling on the surface, but the execution risk is just massive, and it's amplified by that lack of clarity we talked about.
They need to prove they can build a business in Web3, not just sit on crypto while the old problems linger.
Precisely. They need to generate revenue somehow and manage that huge share count.
So ultimately, Ueda Digital Holding has certainly set the stage for a dramatic story, one way or the other. But for you, listening, the key takeaway here is probably caution. Before jumping in based on hype or that low share price, you really need to understand the depth of the risks. Waiting for that November 17th earnings release to get any clarity on their plan seems crucial.
It's a pure bet on whether this new asset value can overcome the deep-seated corporate decay.
And the core question you really need to ask yourself is, do you trust their future execution more than you fear their past history?